Global economy is one of the key topics here at the State of the Union conference in Florence. And when it comes to the global economy, on one hand, it is fair to say that it has shown indeed more resilience towards the COVID-19 crisis than initially feared. But when it comes to the economic costs of the COVID-19 pandemic, they have now been much more than initially foreseen in the very early days of this crisis. The governments around the world did all they could just trying to ease that burden on households and on businesses during these challenging times. But we are now living in a debt-heavy world. But what will happen afterwards with this debt and how it will be repaid? This is the next session at this conference, and the moderator is George Papaconstantinou, Professor of International Political Economy and Director of Executive Education, School of Transnational Governance at the European University Institute.
Hello, everyone. Good afternoon, good evening, good morning to all of you who are watching us online from around the world. Under the State of the Union theme of the global economy, we have just watched a very interesting panel on global tax coordination, one of the most thorny subjects and one where there are potential advances in a very difficult field. So it is natural to continue under the same theme with our panel, who will pay for the recovery and how? So since the pandemic struck, governments have tried to do their best to cushion the economic blow. They have pulled all the stops. They have engaged in unprecedented fiscal efforts at national level. In the EU, both national governments and EU institutions have had an impressive effort in terms of size and also in terms of policy instruments, in many ways breaking new ground. But as our economies begin to emerge from the recession and as we try to build back and build better, the debate has also shifted on who pays for the cost. And we all know that debts have gone up around the Union in every country, and at the level of the EU, there will be new debt that is going to be issued. So the question is, who repays this debt? Does anyone? And if we do repay it, how do we go about it? So to be able to give some convincing answers to these questions, there are a number of issues that first need to be addressed. How fast and robust is the recovery in both advanced and emerging economies? In terms of the fiscal effort, are we doing too much or are we doing too little? Given the fiscal effort, exactly what kind of deficits and debt levels are we going to end up with? What will be the situation in emerging markets and in less developed countries in terms of their debts? Are we heading to a debt crisis? What will be the post-COVID situation in terms of interest rates, in terms of inflation, in terms of taxes? Will we have to raise taxes to pay for the expenditure now? And what are the kind of broader changes that will be required to ease this process? So to discuss these issues, it's a great pleasure to welcome our distinguished panelists. Laurence Boone is the chief economist of the OECD and head of its economics department. Her career spans both the public and the private sectors. She has served as special advisor to the president of the French Republic and has been chief economist at the AXA Group, as well as chief economist at Bank of America, Merrill Lynch. Buchheit is honorary professor at the Law School of the University of Edinburgh. In a long career, he has had numerous university appointments. Perhaps more importantly, he's a legend in the field of debt restructuring. He has worked on more than 24 sovereign debt restructuring and led the legal team advising the Hellenic Republic in what was in 2012 the largest sovereign debt workout in history. And last but by no means least, Mischke is a partner at the McKinsey Global Institute, who are partnering with us in the State of the Union. Over the last 10 years, he has led McKinsey Global Institute research on growth and competitiveness, as well as on infrastructure, construction, and real estate. In addition to a series of reports on Europe, he has led global McKinsey Global Institute efforts on productivity, the future of work, growth, infrastructure, and affordable housing. So welcome to all of you, and thank you for being with us today. We have about 50 minutes, and we will structure our discussion in 3 rounds. In each, I will ask one of the speakers to kick off with some answers to my questions, and then the other 2 speakers will come in and comment. And following these 3 rounds, we will take questions from the audience. So let me take the opportunity to encourage all of you who are watching us through Swapcard to send your questions and also to answer our poll, and we will discuss about the results of the poll in the end. You can find the poll under live discussion polls. So let me start with the first round, and let me turn first to Laurence Boone. Laurence, can I ask you to kick off by setting out for us the broader economic picture? How fast is the recovery? How balanced is it across countries? How unequal is its impact? And what kind of policies are underpinning it?
Thank you, George. It's a pleasure to be here, and it would be obviously an immense pleasure to be in Florence, but it's already super nice and to participate into this discussion. So let me try and sum up where we think we are today and sort of heading tomorrow to set the stage as you asked me. First, I think we should be happy that prospects for the global economy have improved considerably and that we have a brighter outlook. And as you were mentioning earlier, this is very largely due to the amazing monetary and fiscal policy support in many countries, not only the advanced one. And that has preserved the fabric of our economies, many firms, many jobs, and it's an immense progress compared with the management, for example, of the financial crisis. But as you were alluding in your question, the recovery is very uneven. And in fact, the pace of the recovery across countries, but also globally, is determined by 2 key factors. One is the health situation and how countries are addressing it or can address it. And the other one is the extent of the policy support. And on both of these factors, we have very diverse situation across the world, and not only between advanced and emerging market economies, but also within advanced and emerging market economies. So if you look, I would say at the one who have taken the lead in terms of recovery, it's roughly the US and China. They have already recovered the income lost with the pandemic on aggregate. It's not the case for all workers or firms. And they have tackled, at least for the moment, the health situation. And they have provided very massive fiscal support. I mean, you've all heard about the US fiscal support. It has led us to double our growth projections for this year for the US, and it's lifting growth prospects worldwide. Now, the situation in the rest of the world is quite different. Europe, since it's the state of the Union, has also deployed enormous support rapidly to protect their economies. And from an economic, fiscal, monetary, financial angles, I think it's fair to say that Europe has learned the last crisis lessons. It's made immense improvement. But the public health management, on the other hand, has not been as good, and it's delaying the recovery by several quarters when we compare with the US itself. And what worries us is that we know, I mean, it would be too early to actually assess the potential economic losses, but we know that the longer the economies remain in subpar activity, the longer people will remain unemployed or out of work, the higher the risk that the scratches that we are seeing now turn into much more serious injuries. And then there are emerging market economies where there was the combination of both a more difficult health situation. It's obviously difficult to impose the same restrictions as what was imposed in advanced economies, but there's also much lower vaccination deployment and a lower capacity to deploy monetary and fiscal support. And that's when we project ourselves, for example, at the end of this year, it's very clear that emerging market economies have a lot more than other economies compared to what we were expecting in 2019. So what I'm trying to say is when we had convergence in the run-up to the pandemic between, from emerging market economies towards advanced economies, this convergence process risks not only to stop, but also to reverse if the health situation doesn't improve a lot more. Well, obviously, not all emerging markets are equal. Some have managed better than others. Some also have put in place some support better than others, like, for example, through digital cash transfer. So that has been, in some countries, I think, much better than expected. Now, because we have a mix of strategies in terms of health or capacity, that means the virus will continue to circulate. That also means many countries may need to maintain some targeted restrictions on mobility and activity. It also means ongoing restrictions on cross-border travel, and that will affect the prospect for full recovery of many economies, especially the ones that are intensive in tourism. You can think about Spain, Greece, Georgia, and also Mexico or others. So it's super important that we make progress on the health side, but also on coordination for the health pass side that is being built. But I think globally it will have other effects, for example, on trade. It's not easy for containers to get in and out of foreign harbors where people are in different health situations. We've seen it in Europe, but everywhere in the world, it's also not easy for migrants to actually move across border. And it's essential for activities like agriculture, for example. And it's also not easy for business and tourism, as today testifies. So we are recovering, but I think when we look forward, this is a very uncertain and uneven recovery. And it depends a lot on what's happening on the health side. But it also depends a lot on how the fiscal and monetary support will continue looking forward. I don't know if I have exhausted my 5 minutes, so tell me if that's the case, and otherwise I can add a few words.
Let me, thank you very much, Laurence. Let me go to Jan and Lee for a quick comment. An uneven, uncertain, differentiated recovery with Europe doing clearly not as well as other parts of the world, notably the US, and with unequal impacts. Jan, do you share this general picture?
Unfortunately, yes. So we actually see reason to be optimistic in the short term once the health situation is under control in terms of pent-up demand. Household balance sheets are generally in good shape. Particularly among high-income individuals, savings rates have increased across Europe and the US by some 5 percentage points. So some of that money will probably flow back into the economy. At least that's what our consumer research suggests. But we see a divergence also within economies, so a K-shaped recovery where higher income households will have more to spend and will likely fare better than lower income households. And then we also see from a structural point, and I will get to that in more depth later, we see an acceleration for a potential for an acceleration in productivity. But that actually the situation on demand, whether that's via the fiscal stance or via other means, drives and impacts the 5 to 10 year outlook on productivity. And as we have heard from Laurence, there's quite some difference here between the US and Europe. And I might add, there's also actually some difference both on the demand situation, but also in terms of the business fabric and the impact of the crisis so far between North and South of Europe. So we might also see more divergence there.
One of the most difficult issues regarding this particular crisis is that the pace of the ability to get out of it obviously depends on policy, but perhaps most importantly than anything else, depends on something which is very little in the control of policymakers, barring vaccines, which is the health situation and the new variants. So it is a conditional recovery, that much we know. But there is one thing which is not conditional, which is for sure, and this gives me the bridge to the second round, and I'd like to start with Lee. And that's that at the end of, whenever we recover, all economies will be saddled with much higher levels of debt. We have been spending, rightly so, to be able to cushion the blow. But in the end, we're going to see this in the balance sheets of every single country. Some can manage it better than others. So the question here is, how do you see the debt situation after COVID and the differences between the advanced economies and the emerging markets and the less developed countries? How worried should we be? And do we have the tools to deal with a debt crisis if one occurs?
Okay, let me try to give you a snapshot of how I see the debt situation. We entered 2020, so we entered the pandemic with historically high debt stocks in a number of countries, both developing and developed. In the course of 2020, they went up, almost all of them. The World Bank estimates that something like 10% of world GDP was added to sovereign debt stocks last year alone. It has not precipitated a sovereign debt crisis, a systemic sovereign debt crisis, largely as a result of zero interest rate policies by the world's largest central banks and by massive lashings of quantitative easing, which have pumped colossal amounts of liquidity into the market and created a financial imperative on the part of the investing community to find a home for that money. Some of it has trickled down to emerging market borrowers, and for some, but not all emerging market countries, that has cushioned the blow of the pandemic. Looking forward, there's both good news and bad news, I think, for emerging market sovereigns. The good news is that if the economies of China and the United States perform as they are now projected to perform for the next couple of years, that will create markets for products from some emerging market countries, and that will be good news. The potential risk, however, is that if inflation begins to creep up in the United States, and if it turns out, contrary to what the Federal Reserve now thinks, or at least says, if it turns out to be more durable than they hope, it may require a monetary response. And this is the great risk, certainly for emerging market countries. What precipitates a broad emerging market sovereign debt crisis is often an increase in interest rates in the developed economies. Why? Because money can now be repatriated back to the advanced economies and earn a remunerative interest rate. Emerging market sovereigns benefit during periods such as we've had over the last 12 years, when interest rates in advanced economies are near zero and the proverbial search for yield drives them into making more, or at least to accepting more risk. The official sector response to the pandemic, I think, has been quite commendable. In April of 2020, the G20 announced what they called the Debt Service Suspension Initiative. This was a proposal that 73 of the poorest countries in the world would be able to defer for a 4 or 5 year period debt service payments falling due on their bilateral debt, that is government to government debt. That program has been now extended until the end of this year. I think the assessment of the official sector is that the DSSI has been a qualified disappointment. The DSSI called upon private sector creditors to provide comparable relief, but the private sector managed to escape and evade that exhortation. The amount of debt relief that has flowed through to these countries has been less than what was hoped, in part because only 46 of the 73 eligible countries actually elected to participate in the program. Some of the others were fearful that if they asked even for bilateral debt relief, that would result in a credit rating downgrade or an exclusion from the private capital markets. The latest development occurred last November when the G20 announced what they called a common framework for post-COVID debt restructurings for those countries that are going to exit the pandemic with unsustainably high debt stocks. The common framework is not a template for a sovereign debt restructuring in the sense that the Brady Plan was or the HIPC program was. It is really a statement that says that in post-COVID workouts for these 73 poor countries, the traditional bilateral creditors, the Paris Club creditors, will be coordinating their debt restructurings with the non-Paris Club bilateral creditors, principally China. And that is no small innovation. Were this to become widespread, and particularly were it to apply to debt restructurings for middle-income countries, this would be a considerable advance if China, the world's largest bilateral creditor now, coordinated its activities with the traditional Paris Club countries. George, you ask, are we on the cusp of a sovereign debt crisis? I think probably not a systemic crisis in the sense that the debt problems of emerging market economies spill over and destabilize the financial systems in the developed world. That was the case in the 1980s. I don't think we're facing that. We are, however, I think, facing a number of sovereign debt crises in emerging markets, more than we have seen on average in the last 10 years. I'll stop there.
Thanks very much, Lee. I want to come back to you a bit later on a question on China. But before I do that, let me go back to Laurence. Listening to Lee, there's two types of dangers. One, for middle-income and lower-income countries, you have the direct danger of weak fiscal positions and debt which piles up, and which the G20 initiative does not seem to be addressing properly for the time being. And then there's the indirect danger, which is the spillover from policies in advanced countries, and notably the US. And a couple of days ago, the US, having done a very robust fiscal response of different types. But a few days ago, we heard Janet Yellen warn that the Fed may be going to the direction of hiking rates. So the question there is, should we be now worried that stepping on the brakes in the US will have a spillover effect in Europe and in the rest of the world?
Is that a question for me or for Jan?
Yes, it is for you. Laurence.
Okay, thank you. So I think there are two things we need to look at to answer your question. The first one is, what are the real spillover of the US stimulus? And at the moment, we calibrate really what's happening on the 1.9 billion because the others haven't been voted yet. And we don't expect them to materialize in the short term. So this is raising US growth by about 3.5%, and that's contributing to higher growth in the world of at least or about 1%, and half a percentage point, I would say, for European countries, which is material, given trend growth in Europe is generally, not very high. So I think that's a positive, and especially for countries with a strong manufacturing sector, but also some services. In terms of inflation and rates, I think everybody is at the moment trying to assess what will happen to inflation. And all of us can have very good modeling exercise to show, that there will be a hump shape in terms of inflation that happens against a backdrop where the Fed has actually revised its monetary policy framework, so the Fed can look through this hump-shaped inflation. And because inflation are well anchored, it will not spill over. We will instead have people who have left the labor market coming back to the labor market because the economy is booming. And that will bring the low qualified, the people who usually have low wages. And because this economy is booming, then we'll see these wages rising. Obviously, there are risks this doesn't materialize fully. Like one of the risks I think was highlighted before, it's that inflation actually rises, and because we have bottlenecks, then the wage of people rises, and then we're creating some ongoing inflation spiral. If that was the case, the interest rates in the US would rightly, start rising and reflecting what's happening in terms of inflation and growth. Now, for the moment, there is some decoupling between Europe and the US. And I think, the scenario I've described of rising inflation and the consequences for rates is hopefully not for the next few months. And I would think that, Europe needs time to catch up, and the same for interest rates. Lee was discussing the unprecedented QE that is being done, the unprecedented zero interest policy. I think when you look at what's happening in Europe and the pace of the recovery, at this stage, there's no reason to change the policy mix, and especially, and that should help keep interest rates low. But before I stop, we seem to have forgotten that it's not a normal and optimal situation to have interest rates at 0% and along the yield curve. And that rates are rising and reflect rising growth and perhaps normalization of inflation. Not long ago, we complained inflation was too low, may actually be the sign of a healthy recovery.
And that's another question I would like to come back to in terms of how our understanding of how the economy works is changing, and our policy prescriptions as well. Before I get there, let me turn to Jan. And if there's one lesson that we learned from the Eurozone crisis, is that if we try to control a difficult debt situation simply by looking at the numerator, in other words, by controlling expenditure, we're bound to fail. And that the denominator, which is the growth rate, is extremely important. So the question here is, and I think this is reflected in the way that certainly in Europe and around the world, policymakers have reacted in this particular crisis. So the question is, and we know that what drives growth medium term is productivity. So at the end of this, what are we going to see in terms of productivity improvements? Because we are seeing our economies fundamentally changing the shift to online, the different nature of work. Are we going to see these things translating into productivity improvements that would help sustain a higher growth rate in the medium term?
Yeah, we have done deep work at the sector and firm level to try to understand what's happening. And that research suggests that there is actually a quite substantiated opportunity for a full percentage point increase in productivity growth rates across the US and Europe. So that would be more than double the rate that we've seen after the global financial crisis. The reasons for that is well, in a nutshell, it's digitization on steroids. And the stories about remote work and shift to e-commerce have been well told, but what's going on is much broader than that. These are accelerated investments also into areas like warehouse automation, into robotic process automation as banks scale up the processing of loan applications that are partially government sponsored and guaranteed. These are higher utilization of well scalable digital platform or also telecommunication networks. So there's a long list of things that are really structurally shifting. And in a survey of 600 senior executives that we did, actually a full 75% say they're going to continue acceleration into technology investment for the next 5 years. So this is here to stay. And also a stunning 70% say they will continue to increase the level of agility of their organizations and the pace of decision making. And they're also innovating in terms of their business model. So digital innovations, of course, but also, for instance, construction firms finally pushing what is possible in terms of modular offsite construction. So there's sector by sector a large number of disruptions that are being accelerated by the crisis, faster digitization, and all of that we quantify by looking sector by sector as a full percentage point productivity acceleration potential. There's two other structural shifts that go along with that, though. On the one hand, we actually see that many of those advances so far seem particularly pronounced in large superstar firms. So in the US, for instance, a 0% revenue decline for those kind of firms compared to 11% on average elsewhere. 2/3 of all increases in R&D concentrated in just those few handful of firms across sectors, by the way. So this is not only the digital giants. And at the same time, as at the kind of longer tail of the business spectrum, there's let's call it mixed signals. In terms of creative destruction, bankruptcy rates are down double-digit across most European and the US economy due to ample government support. At some point, the bill will come on that front. But new business formations are actually sharply up, plus 24% in the US last year. And they're also up in a few Northern European countries. They are down by double-digit rates in Southern Europe, where on top of that, with 2/3 in the economy in that sector, smaller firms also matter more. So there might be a little bit of another reason for expecting some divergence here. And the last structural shift that emanates from that is that we have arguably entered this crisis from a period of secular stagnation, where we had sustained weak demand, sustained output gaps, sustained soft investments. And now 2/3 or 60% of the kind of productivity accelerations we see are geared at reducing labor. And the kind of effects that we see, faster digitization, faster automation, more superstar effects, are essentially all points that have been associated in the past with more polarization and less spending power among lower income people who have the highest propensity to consume. So there are some structural headwinds on the demand side. And that is why we also think it's going to be so critical to make sure the policy setting is right to keep demand up. And you can also infer from that, while we don't do any macro research, if you do get a full percentage point productivity acceleration and you do have stronger structural headwinds on the demand side, that may lead you to reassess some of the inflation and other risks.
Let me push you a little bit on that last point, because you described a very interesting process of creative destruction. Now, a process of creative destruction has the creative part and has the destruction part. And it's quite clear we are seeing, and you're documenting this in particular sectors, the productivity impacts of digitization, steroids, as you put it. But there's also the part of the layoffs, the bankruptcies, and these are not spread evenly. These focus on particular groups, which are more vulnerable. And do you think that first of all, we're paying enough attention to this? What exactly are we seeing out there? Are we going to wake up 6 months or a year from now and realize that this process has created a new underclass in a certain sense, that has left behind even more people than are at the moment? And are our policies geared towards that?
Well, you put it very well. So I do think more could or should be done. So the reduction in bankruptcies is particularly pronounced in hospitality and transport, and kind of the sectors most affected by this crisis. So this is clearly a sign of the government support behind, which will end at some point. Now, by the time it ends, we might be back in a situation of pent-up demand. So these companies might actually face strong enough demand. But definitely, we will need to invest more as a societies into the reskilling, into more digital capabilities. And we will need to invest more in making sure that also smaller firms can move alongside, where you see that the best predictor of advancement on the digital agenda is actually that you have done it in the past. So this is really a path dependency and capability problem. So smaller firms will need support. And we can also, of course, raise questions about the role of large digital platforms that they have in actually supporting those smaller firms versus competing with them.
Thanks. So this comes back to the policy stance. And Laurence, if I can come back to you on that one. I mean, we're fretting about whether the US is doing too much and whether they're overshooting. And it seems to me that we're less worried whether in Europe we're doing too little. We are content, and I think rightly so, that we actually, for once, the reaction was fast and it was innovative, and it introduced new tools that were not there before, the borrowing at the European Union level, for example, and the new Next Generation EU. But are the amounts in there enough to be able to, A, get the economies going again, and B, attack the kind of issues that Jan was just discussing, meaning the increased inequalities that we're going to be ending up at the end of the crisis?
Thanks. So that's the Tony question. I thought I would escape it, but I should have known better from you. So the first thing, I think, we have to be very realistic and practical, right? The US is enjoying this boom, not only because of the sizable fiscal stimulus, but because the economy is reopening. There's no, there will be no higher spending from households as long as the economy is not working. We cannot travel, otherwise we would all be with you. We cannot go to cinemas, restaurants moving, there's so much you can spend. So I think we should keep in mind that part of the delay is definitely the health situation. The other thing, and I very much enjoy what Jan was saying, I think as a complement to what he was saying, I would like to insist on 2 points. The first one is, as we reopen, effectively, what is on the background of Jan's words is there's a huge reallocation issue going on, and we don't really know the size, but commerce, retail will never be the same again. The consumption habits are changing, the work habits are changing. So the firms are changing what they produce and the way they produce it. And what will make the dynamic of the recovery is also the ability of some firms to die and reborn or born differently or adjust to the new situation, and for people to move from one job to another. Now, we know there are two types of policy for this, which are really key. No, three. One is competition, right? If you don't have competition, then you protect those firms to whom you have given cash during the crisis. They are not very good, but they employ a few people and they're going to continue. Jan talked about superstar, and here I'm talking about zombie. And I appreciate, Jan, you leave me the bad role for this, but that's one thing. Competition is essential to have the creative destruction you were giving. The second thing is education. And I think it's, we've seen the divide, right? We've seen people who are not able to connect, professors who are not able to deliver the best courses. We've seen it geographically and across people. So with digitalization, first there are investments to connect people to broadband, and all OECD countries are very far from covering their geography with a very good internet connection. And second, we have to reskill people. Now it's easy to say, and for people who have a certain level of education, it's fine. But bear in mind that people who left school at 16, they might not want to go and get some training again. So we have to get firms to actually partner to train people in jobs. And that, I think, is a joint policy between the public sector and the private sector. So competition for firms, education for people. And I think the last thing to keep in mind is if we want this reallocation to work, we need to keep, and Jan alluded to this, we need to keep a certain level of demand, because if you withdraw support from firm, from people, and at the same time you cut on fiscal policy, then there will not be enough demand for firms to continue to thrive, invest in new technology and invest in people. Thanks.
Thanks. The preliminary results from a poll that we're having is that most people believe we should be spending what it takes to get out. But this brings me back to Lee and to a question regarding debt. And I want to pick up on your brief mention of China and link it to a geographic area, Africa, which is perhaps particularly vulnerable in terms of being able to sustain a recovery given the very high costs of COVID crisis. And there's a recent study comparing contracts between Chinese state-owned entities and government borrowers in a number of developing economies, including Africa, but not only Africa. And it shows that there's certain particularities, for example, in terms of transparency, disclosure of the levels of debt, in terms of collateral, no Paris Club clauses, and in terms of policy influence. My question is not about the specific investments. My question is whether this kind of this type of investment behavior could trigger, in fact, a more systemic crisis in a particular region of the world.
I don't think so. That study was quite interesting in that it was the first time that we had some insight into the documentary practices of Chinese lenders in emerging markets. And there were some surprises there, but honestly, I think we should not over-lawyer this. China, as the world's largest bilateral creditor, derives its leverage not from its contracts, but from the fact that it is the world's largest bilateral creditor. And whatever is said in the contracts, the recipient countries are going to be reluctant to bruise China as a potential source of borrowing in the future. The analysis to date has been that, contrary to the propaganda that some in the official sector put out, China has not precipitated a debt trap, as it's sometimes called. China has been prepared to restructure its loans when circumstances require it. The suspicion of China, I think, derives principally from the fact that they have always done that in a bespoke way. They have always been obsessed with confidentiality, and so, and they have resisted the requests that they join with the Paris Club countries in coordinated approaches. They've resisted that until last year with the debt service suspension initiative and now with the common framework. So I think one can overstate the risk of China as the propellant for a sovereign debt crisis, either in a particular country or in a region. There is one aspect of this, however, that is particularly troublesome. And you see it in a country like Zambia that is attempting to restructure its debt now. Each creditor group, commercial, Paris Club bilateral, and China non-Paris Club bilaterals, each creditor group suspiciously watches the others. None of them want to be the ones that provide the debt relief that allows the sovereign to service in full and on time its loans from the others. And that suspicion and jealousy prompts a debt restructuring framework in which you really need to have comparable sacrifice or comparable burden sharing among the three groups. In the case of Zambia, China, a very large creditor, has not indicated its willingness, or at least the terms on which it's prepared to restructure its debt. And so the bondholders, the commercial creditors in Zambia, are saying they don't want to move forward until you see that. This is, I think, where we must move if this system is to function, that there has to be an adequate disclosure of the liabilities and then coordinated, comparable burden sharing.
Can we stay in Africa for the moment? One of the questions that we have comes from a participant, somebody who's watching from Liberia. And Jan, I'm turning to you on this one. On the questions about the role of African leaders in ensuring a global recovery and how would it impact on African countries' growth and productivity in the medium term. And I wanted to take this as an opportunity to ask, because we talked about divergences within countries, and we sort of the kind of possible opening up of additional inequalities within countries. But then, of course, there's the international dimension. Are we seeing here a situation where the US, having pumped, no brakes, is going to pull ahead, Europe struggling behind it, China coming through, but the weaker parts of the world, Africa being one, being left behind?
We haven't researched Africa in any depth in this research, but surely I would see a situation that this crisis, which is really unleashing a wave or a step up in digitization that we've been in a way waiting for quite some while, and where many people have worried for quite some while why we don't see the respective productivity advances. That this step up will be most pronounced where, on the one hand, there's demand strong enough to also manage the transition. So if there's so much demand for workers, so much that they can actually also shift skills by force, but also where the technological capabilities and the managerial capabilities are highest. And at this stage, this is the case in the US and in China. So I do think the risk of further international divergence is very real and tangible.
All right. Let me go back to Laurence and pick up the conversation on policy where we left it, which is that you talked about a situation of secular stagflation. There's a piece in the FT this morning which talks about multiple equilibria in the world economy. As economists, we tend to think that the economies eventually gravitate to an equilibrium. But perhaps, our models need to change. We are facing a fundamentally different environment, which is punctuated by structure shifts that we have not had before. So our understanding needs to change, and seems to be shifting in the economics profession, and our policy tools in terms of, for example, what we consider to be sustainable as debt, or the right mix between monetary and fiscal policy, or the role of central banks, seems to be evolving in a very rapid way, not just on the fiscal stance, but more broadly. So do you think that we are learning new tricks?
Yes, we're always learning anyway. And I think, we can make projections, but we're trying to span the universe of possible things and to give some kind of range of uncertainty for policymakers to actually act within this range of uncertainty. But I think if we manage to do that, we're already good, doing a very good job. What is very striking when we look at both sides of the Atlantic, actually, there are many striking things across the globe. You think about what Lee was saying about China entering something that is negotiating with Paris Club. That's really new. You were asking about Africa. They're using actually digital tool to see at the right time, weather-wise, insurance companies are helping them to do this. And also one thing we have seen in this crisis is how emerging market economies have used mobile phone or digital tool to actually wire cash to people who lost their job or who couldn't work. They've also done QE, central banks in emerging market. Nobody expected that. They have actually been able to issue a lot more in local currency, and that's also very new. Whether there's a big paradigm shift, I think is a big question, and I will say two things on this. The first one is, if I exclude the first of the 3 US plans, so if I exclude the 1.9 trillion we discussed at the beginning, and I look at the investment plan, which is the second plan, and I look at the social plan, which is the third one, what the US is doing in a way is very similar to, it's converging towards the European social welfare model in a way. Is that new? Probably not. Will it be the same exactly? No, but it's some convergence in that direction. If I look at what we were saying for debt at the beginning, I think one thing which is really key is that monetary policy with QE and with the interest rates very low has actually enabled fiscal policy. Now, for this enabling to last and to deliver productive spending, productive investment, we talked about digitalization a lot. We could have talked about climate. But for this to actually materialize, I think that this spending needs to go into productive usage. Because one thing hasn't changed, I think it's the mistrust from countries who have actually managed their public finances well in the past towards the others. And reciprocally, I think the countries which had less well managed their public finance are always concerned that they are continuing to do so. So I think where we need to change is on public debt management and making sure that it actually is channeled to the right spending, that there is proper policy evaluation. And by the way, we've got a lot to learn from the US on this. And that is the key for monetary policy to continue enabling this spending, and that we get the right sequence of recovery, fiscal policy accompanying the exit and investment, and then normalizing, and then after, assuming we have no inflation or little, then we can get monetary policy normalization. So same thing, pieces of the juggle of the jigsaw are in different positions.
Thanks very much. We could continue this conversation for quite a long. It's been very wide-ranging and interesting, but we're out of time. So I'd like to thank very much Laurence Boone from the ECD, Jan Mischke from the McKinsey Global Institute, and Buchheit for their intervention. And thank you all for watching.